Let's get started today. Today's program is called The Big Takeaway, and one of the things is Mark Rylance, who's a certified financial planner. We got together after one of these programs and kind of said, instead of the last session being a review of what we have already done, what do we really want people to take away from this program? And so Mark put his head together and designed a program for today, and I'm really anxious to hear what you all think of the program, because I may not know him next week. So it's going to be a pleasure to watch this. The Ask First form is what we're going to introduce Mark with. There was a blank one in your package. There's also a blank one on our website. But I find the Ask First form so helpful even to me. When I introduce or find new speakers, the first thing I ask them to do is to complete the Ask First form, because it tells me so quickly their education level, years of experience, what kind of licenses does the person have, whether or not they sell annuities or mutual funds or insurance, and then they certify that the above is true and correct. This little piece of paper, if you were to go in arbitration and somebody were to lie on this or misrepresent themselves, it would help you immensely in court or in mediation. And it takes 2 minutes, or how long did it take you to complete?
Took me about a minute to complete and about 30 minutes to make all the copies.
So it doesn't take long. And remember, it's your money. It's not your children's, it's not your advisor's, it's yours, and you get to do whatever you want with it. And so do not be embarrassed or to ask for this type of information from an individual that you may employ. So we're not going to spend a long time on this because everybody kind of has a copy of it, but let's just go through no relevant licenses, which basically means you don't work on commissions.
Correct.
How do you charge for your services?
Our firm actually charges on a retainer basis, so it's a flat fee.
So that's a little bit different than what we've had before. Most of the individuals that we've had speak charge on an assets under management. What is the difference between that and a retainer?
Well, the reason we switch, let me back up. Our firm has done hourly, assets under management, and now retainer. And there's good and bad about all of them. We gravitated towards the retainer because for some clients we're doing a lot of extra financial planning, and I don't think it's fair to charge one person that is basically getting mostly investment management and someone else that we're spending 100 hours per year. So it's just a better way for us to charge clients. It's more fair. And also what's interesting about the retainer model, because it's being talked about in our industry as the new hot thing, even though we've been doing it for 5 years. But I think clients get a better value because assets under management, because your investments typically go up more. If your investments are annualizing at 6 or 7% rate of return, so is your fee. So ours is a fixed fee, and people like it because they understand it. They know exactly what it is.
And they approximately use the 1% of the assets under management model, and then they go from there either lower or a little higher. The financial services industry has all sorts of built-in conflicts. And so the retainer agreement sometimes reduces those conflicts immensely. Any questions regarding how Mark charges? Yes?
How exactly does retainer work?
How does the retainer work? In other words, I give you $500,000 to invest of my money. Of course, it's fictitious. So how would you charge me if I had it all in stocks and bonds?
Well, technically how we charge is quarterly. Okay, so you just take the fee divided by 4, and that's your quarterly fee. The way we build our fee is based on the amount of work that we think we're going to be doing, because we have some clients that have 10 different accounts, 3 different entities. They may have family limited partnerships, corporations, trusts. And so we try to do it based on the complexity and the amount of time, because sometimes we have one particular client that we have to think in 3 different entities, and all 3 have different goals. So I don't know if I answered that, but that's...
So it would be approximately 1% or less, because stocks and bonds would be fairly easy to manage compared to if you had income property, if you had different trusts, et cetera. There's a free meeting, of course, I'm assuming. Mm-hmm. And in that meeting, he would want to look at your financial matters, and then they'll come up with a fee, and then you can accept or reject that. All of the speakers that we've had throughout the program offer a free session with you. I think it's a wonderful way to kind of educate yourself as to what someone else thinks of your portfolio. And there literally is no obligation to go with that particular individual. They can quickly assess and look at your statements and see kind of where or not you're with a commissioned salesperson. Many of the popular funds, they'll know right off the top of their head as far as their expense ratio, and it gives you some different feedback. Now, there's all sorts of different investment philosophies. We've seen Christine is primarily an investment advisor. Mark here is primarily a financial planner. He'll look at your entire situation, cash flow, net worth, et cetera. Am I?
Yeah, I mean, I guess the term, or the industry calls it wealth management. And so we are managing money for clients, but we are also doing the heavy lifting financial planning, which includes taxes, estate planning, cash flow, education for those who have kids or grandkids, and really everything.
Yeah,
it's comprehensive.
Whereas Jim and Christine, those individuals were primarily investment managers. You give them the dollars and they invested in the market for you. They will do some of the financial planning on the side if you ask them to, but that's not their primary profession. Okay? There's no wrong way. I think either way is correct, depends on what you need, but that investment philosophy you need to be familiar with. Any other questions? Yes?
How about tax consequences? Do you monitor that sort of thing and build?
Yes, yes.
The question is, Mark?
Tax consequences, do we pay attention to that? We don't do tax returns, but we do tax planning. Yes.
Okay. Any other questions? Yes?
Yeah, I mean, typically, our firm was started in 1976. We have about 110 clients. So, I mean, a minimum, if we're managing money, is probably around $1 million, somewhere around there.
Somewhere around there?
Somewhere around there. It depends. We look at people, are they really nice people? Or, you know, I don't know. No, I mean, one good thing that Pete's talking about is I always recommend the same thing. Talk to at least 3 people, and because you're going to, and ask, drill down on the questions to try to understand their investment philosophy. And I'll talk a little bit more about this later,
yeah.
Whether they're empathetic and they truly care, and whether they're comprehensive. And you'll get a gut feeling after talking with 3 or 4 people.
And by the way, that $1 million is, is loose. And what I mean by that is not that they're loose, but they're, if you have family members that are going in, if you are a very nice person, they'll do a lot less. And even if you have a lot less, don't hesitate to have a review done by Mark or any of the other individuals here. It's just great to get a second opinion. All righty? Last question, then we're going to get going.
The question basically the custodianship and the trading.
You want to repeat the question?
The question was, what custodian do we use and what type of trading arrangement? Our go-to is Charles Schwab. Mainly, they're a discount broker. They're as inexpensive as any firm, but they have great back office for us. They're great on the service end. But we have clients that have Ameritrade and Vanguard and Fidelity accounts and things like that. Charles Schwab is our primary provider custodian.
Some German guy, who started a little brokerage firm. Charles Schwab is interesting is that he started actually here in Laguna Hills. And what do you think is the size comparison from Charles Schwab to one of your wirehouses? I mean, do you think they're about equal? Charles Schwab earns like $250 million per quarter, which you think is a lot until you see what some of the other wirehouses earn. And the other wirehouses earn somewhere in the vicinity of $1 billion. Charles Schwab is a tiny, tiny player in the financial services industry. So it's just because it's fee only. They don't have commissions. They're trying to sometimes creep over to that.
Tough to make money at $8.95 a trade.
It's very tough to make money at $8 a trade. So, but be careful. Okay. Well, I'm going to institute the rule that we had last week and the week before. And let's not have any interruptions, and we're going to have time for questions at the end. We're also going to do two things. One is, please, I would love for you to complete the evaluation form. It's really important for us. And the second thing is that at the end, we're going to do the stock market contest. So we're either going to pick out Warren Buffett or Mrs. Buffett, one of the two, and see. And we have some fabulous prizes. I don't know if you know this or not. This is genuine plastic with a little magnet on the end of it. You can't get this everywhere. And we got some pens and some cups. And so, by the way, if you have done all 8 weeks, you've probably spent more time sitting in here listening to experts than over half of the designations in the financial services industry. Wow. Isn't that amazing?
Thank you.
No, you're welcome. But I mean, we ought to walk out, so you should have a certificate and that you're all now wealth managers. Because you spent more time than most sitting in here. So, Mark, are you ready?
I'm ready.
Okay, let's go. It's all yours.
Okay. Okay, as Pete said, this is a new presentation. I've given it at a couple locations, and what I originally did was I approached Pete because I've spoken at a number of these sessions, probably done every one at one point except for long-term care. And I said, Pete, you're missing one very important part in that these people, everybody in attendance is learning a lot of the technical, practical stuff, but you're not focusing in on the fact that we as humans make a lot of mistakes and that we're irrational. Okay, so my presentation today is going to be two parts. One is to kind of come back and focus on some of the things you've already learned, but the first part, probably the first 20 minutes, is going to be on our brains and how we make decisions. Because a lot of people, first thing out of the gate, I'm going to show you that the average investor underperforms the index dramatically, okay? And I'm going to kind of spend probably 10 minutes on the brain as to why this is happening or why researchers think this is happening. And then I'm going to go into some practical steps on how you can kind of protect yourself against yourself, okay? But before I do that, let me go through this stuff right here, because most of my stuff is going to be on investments today. But I want to say this whole program, whether as a wealth advisor or wealth manager, whether someone has $100 or has $100 million, we're going through the exact same process with our clients. And in fact, whether you're an individual or a corporation, it's the same thing. You build a net worth statement. You have a cash flow analysis. You're analyzing income tax, insuring against risk that you can't readily write a check for. Okay, so one thing that really surprises me is most people don't even check their net worth from one year to the next. Is it higher? Is it lower? I mean, it's really basic stuff. And also, like if you're a business, they have a balance sheet which has all their assets. They have a profit and loss statement, which is income less expenses. And And it's just a good thing to do, not to go through your expenses every single month, but to have a good understanding of your expenses and have a plan, okay? And so a lot of the stuff that we do is that specifically because it's so hard for us to do individually, okay? So again, I'm not going to talk more about this stuff, but I do, on the insurance and the estate planning and tax stuff, your best source is to find a good professional in that area and help them help you, okay? So here's my agenda today. I kind of told you a little bit. I'm going to focus on the investor scorecard, money in your mind, and then I'm going to give you 6 big takeaways. There's probably about 12, but our brain capacity, we can only process 5 to 7 variables anyway. So let me go through the investor scorecard. This is a study done by Dalbar and Associates. It's a Boston-based research company. They do it every year, and I've been watching this for the last 10 years. And what they do is they analyze what the index did versus what the individual investor did, okay? So over the last 20 years, equities or stocks have averaged just under 8%. Bonds have averaged 6.5%. I blended the two. If you had a hypothetical 50-50, half in each portfolio, and your return was a little over 7%. The average investor, here's their results. So, and this is annually, okay? So the average stock investor every year trails the index by 4%, the bond investor by almost 6%, and a 50-50 investor by 5%. So they track these things. It's not the most exact scientific study, but Morningstar has also done a study, and they track inflows and outflows of mutual funds. So if it's the bottom of the market, say the Great Recession in 2008, they know exactly how much money went out of stocks or sold at the bottom of the market and went into bonds, and so they track those flows on a monthly basis. So, but I can tell you, even though it's not 100% exact, it is right. At least people do underperform pretty dramatically. So the question is why, and I've already given you the punchline. This is a simple diagram that shows why. I mean, we tend to, the concept is to buy low and sell high, correct? That's how you make money. But what happens is the average investor rides this roller coaster of emotion, and think of right here the tech bubble in early 2000. And when we were in a brand new economy where this time is different, every time you hear the words this time is different is either right here or right here, okay? So what happened, all the money flows were going into tech stocks and growth stocks. People were selling all their other investments to go in there. Boom, market collapses, huge losses. And then all of a sudden, you go back down here, and I had this in a previous presentation where I tracked the money flows in 2002, which was the bottom of the market, and it was the all-time highs going into bonds at that point. So people were buying bonds, the things that, selling their stocks, which they should have been buying stocks, and then selling their bonds. So investors do the exact opposite. Not everybody here, but we love to go in herd behavior, and it definitely affects us, okay? So takeaway number 1 is know thyself. This is where I'm going to go into some brain stuff. Are there any brain scientists in the room? Raise your hand. Okay, because I'm going to butcher this if there are. But let me just take a couple, probably 10 minutes and go into the research. Okay, there's a new concept of economics. There's modern economics, which is, Ben Bernanke and most of your economists are studying supply and demand curves, and there's a whole different theory behind that on the academic level. But there's a whole subset that is now created probably in the last 10 to 20 years called behavioral economics. And it actually is part of the economics department of some of these institutions. And what they are studying is not necessarily supply and demand and things like that, but they're studying the behavior, what they do, what people do in certain circumstances. And it's fascinating research. There's probably 1,000 books on the subject and probably 1 million articles if you ever Google behavioral economics. But the main concept is, oh, my little color went out there. is that investors make emotional mistakes, and then we also just flat out make mistakes in judgment. Okay, and I'm going to talk a little bit more about that. And it's basically because of our brains. And then I'm throwing in, I think the media has played a huge part, especially in the last 10 years, with the availability of all information. Okay, 24/7 information. So I'm going to poke fun at the media later because they are low-hanging fruit. Okay. So the evolution of our brains. Let me. This is our old. There's three parts of the brain, three main parts of the brain. There's different subsections, but our old brain is the brain stem, which all animals have. Okay, and the brain stem, what it does is it's our basic bodily functions. It's digestion, blood pressure, sweating when we're hot, basic bodily functions. Okay, so that's right at the brain stem. Our limbic system. Has anyone heard the reptilian brain? Okay, this is our emotional control center of our brain, and what it determines is, sir, what's your name? Plug. Okay, Bob. Is it Plug? Okay, Plug. If we're sitting across the table from each other, our brains have the ability to put each other in a box in a very short order, maybe in like 10 seconds. Are you a friend or a foe? Okay. It's also...
He's a foe.
He's smiling. He's still smiling. He may be a foe later. But friend or foe, fight or flight. Okay. This is our emotional part of our brain. Okay. And also, what's interesting about the research is that this brain actually learns from emotional experiences, and I'll talk more about that later in just a few seconds. The new brain is our big brain, okay? The neocortex. And what it does, it's involved in decision making. This is when we think of ourselves as rational human beings, this is the brain that we're referring to. Problem solving, purposeful behavior. What that means is we can reflect. The human species is the only species that can actually reflect on something that happened or is going to happen. Last night I'm hoping this thing's going to go well and I'm playing it out in my mind. Other animals can't do that. Consciousness, and also it does have an emotional component to it. Okay, so three brains: brainstem, limbic system, and then our big brain, the neocortex. Okay, so let's talk about emotions. What research is finding, and now in the last 5 or 10 years, they've been able to take MRIs, like we get an MRI for our knee or what have you, of the brain, and they can show people, test subjects, a picture. Say it's a very gruesome picture, and they can determine in the brain which part of the brain lights up. Okay. And what they're finding is when it comes to investments, this thing called the amygdala is the control center of our emotions. And it's about the size of an acorn, and we have one on this side, one on this side. And if you take like a pen or something and you were to stick it through your ears, there's one there and there's one there. And what they're finding, in our office, if there's an emotional event, I always go like this and everybody knows what I'm talking about. So this is actually it right here, and then you also have one right here. This is where our irrationality comes into. Can you see okay? Okay. The irrational behavior, this is where it's happening. A couple things. There's some studies by the founder of this behavioral economics. His name's Daniel Kahneman, and he had a partner, Amos Tversky. And they started doing research about 15 or 20 years ago, and they discovered this thing called loss aversion. And some of you may have heard about this, but what they found is if people get affected emotionally twice as much from a loss than they do a gain. So if you lose money in the stock market, that affects you 2 times as emotionally as making a bunch of money. And so what happens is there's all these biases that they have determined that people do on a regular basis, but this is why people who their stocks have collapsed and they just want to get back to even. Okay? As soon as I get back to even, I will sell it. So people have no problem selling their winners, but they have a hard time selling their losers, even though the situation has changed and things are probably not going to come back because the pain of taking the loss is 2 times as great. I mentioned the learning aspect of this. This is some fairly new research that's very interesting because it goes into intuition or that gut feeling that we get. So say you did interview 3 advisors and you have a kind of a gut feeling. What they're finding is this little part here and here actually has a learning component, but it's based on emotion. So if we in the past have felt a specific emotion, say you lost a bunch of money in the stock market, we will learn from that concept, from that experience, and it will affect us on a very subconscious level. So the research has also told us that, especially in this amygdala, that in times of uncertainty or crisis, that this little thing here, the size of an acorn, actually becomes the master of our decisions, and our big brain, our logical brain, becomes the servant. Okay? And so a lot of this stuff, I'm just giving you a background because I'm going to show you some stuff because a little later they'll make sense.
Mark, is this one of the reasons why when you choose a financial advisor, you have to make sure that you understand how they're compensated? You have to understand that they're competent in what they're doing. But the third part is that you connect emotionally with them?
Yeah, absolutely. There's well, you're going to get a gut feeling. This person is safe. This is a friend, or this is a foe, and it could be some experience back, 10, 20 years ago. It's hard to determine. They're still uncovering, I'm sure, as you can imagine, the brain. The brain is the most complex organ, by far. But the amygdala, again, when this comes in, is this fear and greed. When people are greedy, they tend to buy. When they are scared stiff, they tend to sell, okay? And then repeat until broke. Okay, so that's the emotional part. But the brain also makes a lot of mistakes, okay? There's a part of our brain, this neocortex is the whole brain here. Right here, behind your eyes and right here is your prefrontal cortex. And they found that this is the supercomputer of the brain, where it takes in the information from the brainstem, takes the information from the emotional part of our brain, and then our logical, and then it processes all the information and comes out with our thought process and actions. What they've found is that we can only, as human beings, process between 5 and 9 variables at a time, okay? Which, when it comes to investments, is a big issue because, if you just take the concept of the election or Europe, the troubles in Europe, there's probably 100 or 200 variables that could take place. And so our brains, as soon as it hits the 5 to 9 variables, shuts off and takes shortcuts, okay? And these shortcuts could be, confirmation is one of these biases that I know exists. Confirmation bias, you don't have to raise hands, but what this says is that we filter information in whatever confirms our belief system or our bias. We take all that information in, and whatever is the opposite of that, we kind of just sweep it under the rug, okay? This is why Republicans in the audience, and I'm sure there's quite a few in Newport Beach.
They're all Democrats.
Yeah. That's why you watch Fox News, and you wouldn't be caught dead watching CNBC or MSNBC, and vice versa, okay? The same thing happens with economists or investment advisors. For those people who think that a bear market is approaching or the economy is going to go into recession, you read information that confirms your bias, and then you discount all the other information. And so what happens with advisors is some new information, very positive information about the economy could come out, but they don't pay attention to it because it's the opposite of their bias. Extrapolation, I'm just showing a couple of these. Extrapolation is, let me see if this goes. We tend to overestimate our certainty, okay? So people, like take Apple stock, for example. Whoever owns Apple stock in there is convinced that this time it's different. This company is an innovator, and it's going to go to 1,000, and it's never going to go back down to 200. So we take our expectations and we project them, we extrapolate them out, whether it's a positive thing or if we think something is going to go down, we just extrapolate it down. So this is a shortcut, okay? And the brain does this all the time, okay? And then another thing which, oops, I'm sorry. Sorry about that. Okay, another concept which I didn't share with you this last time is anchoring, okay? I don't know if this is going to work. This is brand new. Okay, so the human brain also anchors information. If we have a belief, we will put that in a compartment back here that, so if I take Apple stock, for example, and there's been studies on this, Apple stock is probably $600 a share.
I'm sure somebody knows what Apple stock is today.
What is it today?
We don't have any Apple lovers?
Okay, it's 6:30 and 1 cent, right? No, the market's closed, so it's the same as Friday. Okay, so if we had earnings estimates, okay, or people who were trying to put a price target on Apple, and let's say we had 3 economists, okay, and I said, one person said it's going to be $750 by the end of the year. Another economist said it's going to be $800, and then another one said it's going to be $500. So what we do as our brains will anchor on a concept, meaning these two are higher, and it almost looks like a consensus, right? This one is so low, it's an outlier, so we discount, and that can't be right, okay? So the brain does a lot of weird, strange things, and that's the point here. And if you type in bias or behavioral economic bias into Google, you'll have a list of about 200 different biases that we have, which makes it so hard. Okay, so moving on. And I think I'm done with my brain part. You guys are still awake, so that's good. Okay, so back to this behavioral economics. We make emotional mistakes, and we also just make flat out, logical mistakes. So the brain we've talked about. So now let's talk about the media, because I think this is just a huge factor on our decision making. As I said earlier, the media, it's different. It's 24/7. I can wake up at 2 in the morning and read Google for days, okay? There's not a shortage of information. So this is my little thing here. Investing and entertainment, because that is what the media is. The media is there to sell advertising. And how do they sell advertising? By having a lot of eyeballs on it. The media likes, they love this storm that's going on right now. It's tragic, but they're all over it. They love train wrecks. They love stock market crashes. They love the troubles in Europe, okay? It sells advertising. But don't mix up the fact that this entertainment, that the media is entertainment, okay? And what they do is they tend to sensationalize. It's 24/7 news information, and they also I'll talk a little bit more about their expert opinions. Okay, so let's talk about sensationalize. This is that same chart, a little more detailed, but this is the roller coaster that we all go on with any decision-making process, but especially investments, okay? So right here, there's optimism, excitement, thrill, euphoria. Apple's going to 1,000 or gold's going to 5,000. And then all of a sudden, the markets drop, and there's anxiety, denial, fear, desperation, panic, capitulation, despondency, and then it all starts over again, okay? So this is when people buy. This is when the massive amounts of money flow into stocks, think the tech stocks again, or the bonds at the end of 2002 or in 2009. And then same thing down here, they end up, when the capitulation stage is when the sales process, they start selling the things, and they say, if there were any other advisors in the room, they would know what I'm talking about. They say, Mark, I know you've told me 100 times, you've educated me that this was going to happen, and I know this is the dumbest thing I've ever done in my life, but do it anyway. Sell everything. Okay? So their brain is going rationally, I know what you told me, I don't care. The amygdala kicks in and says, sell it. Sell everything. And luckily, we only had one client that did that.
Jones Industrial's down almost 300 points. We are down more than 400 points.
The Dow is now down 500 points. Down nearly 600 points.
It's down 631 points. Wall Street spending yet another day in what's being described as freak-out mode.
For investors, what is your advice today?
Okay, whatever money you may need for the next 5 years, please take it out of the stock market right now, this week. I do not believe that you should risk those assets in the stock market.
Even if you would take a tremendous loss in selling your stocks at this decline, you say take it out?
I don't
If you
care.
leave it-
I
if
do
you
not
leave
care
it
where
in
stocks
5
have been.
years.
I do not care where stocks have been. I care where they're going. And I don't want people to get hurt in this market.
But if you need it after 5 years, then don't touch it.
Well, yes, if you have that much flexibility. I'm worried about unemployment. I'm worried about your purchases that you may need. I can't have you risk that in the stock market for the
Very
next 5
dramatic
years.
statement, Jim. Very dramatic statement. For
I
savers,
thought about this all weekend.
Yeah?
I did not want to say these things on TV.
Okay, so our friend Jim Cramer, or our favorite punching bag, this is the guy that's ringing the bells and, you know, Bozo the Clown kind of stuff. When he goes on the Today Show and says, I'm scared, sell everything. If you have less than 5 years before you need your money, sell. That's something that affects you, because this is the permanent bull on the stock market. And so what happened, Jim Cramer, back to our little chart, ran up. He's usually in this area. And then also at that time, he was at the capitulation stage, him personally, okay? And so anybody who was watching the Today Show that had a great amount of confidence in Jim Cramer probably just had a wake-up call and probably did something that was irreversible, okay? That's the power of the media. So let's see how Jim Cramer did. This is a chart of the S&P 500 going back to 2008. Okay, so that video was during the Great Recession, and I believe it was right here in October of 2008 was when that was taped, when he was on the Today Show. So he basically said, sell everything, okay, because none of us have a time horizon more than 5 years. Are you kidding me? I can't even think through next week. So he was right. Oops. He was right. The market did go down another 20% from there. But what happens, so you sold here, and then now if you would have just held, it was a very quick drop, and boom, within a matter of 3 or 4 months, you were back to whole. Or maybe a little bit longer, maybe 6 months to 9 months, you're back to whole. But what happens, and we've seen this in our business, with new clients that come in our door over the last year or so, they're still sitting in cash. They're in cash from selling down here during the capitulation stage. Because what happens emotionally is at the very bottom of the market, you can see it just collapsed. And then all of a sudden it shoots back up. And what happens, because I've had conversations, is people say, well, say the market was up 5%, right from the bottom, and it's up 5% in one day. The Dow's up 600 points. So mentally we say, well, let's wait for a pullback because it jumped up a lot. And then what happens the next day? It's up another 3%. And then it's up another 3%. And so all of a sudden the market's back up 10, 15%, and you are frozen, okay? You are sitting in cash, earning no return, and you are frozen. The better strategy, and I'm not saying that we're all subject to getting scared, and that was a really scary time, is that you need a plan before the event, okay? So who was the speaker on investments?
Christine?
Okay, so when she was talking about asset allocation, which is a fancy term for how much you have in stocks and bonds and cash and alternative investments, you need that mix to be appropriate according to your goals. And you also need to be aware that this is going to happen, that your investments, if half your money is in stocks, that at some point, guaranteed, you're going to be down a minimum of 20%, okay? And the key is you need to sit tight because you can't time the market. Those who think that they can time the bottom and then time the top, like they sold here and then bought here and keep doing it, you're in a vicious cycle because you have to be right every single time. One mistake, you've blown it, okay? So you hear people in our industry say, buy and hold, which I agree with and disagree on different levels, but the reason you buy and hold is because you cannot time the market. We are unable to, there's no one I know that can time it every single time. They may get it right 2 or 3 times in a row, and then they miss it. Okay? And by the way, the S&P 500 was up 50% from where he sold in a matter of 3 years. So let's talk about 24/7 news information. You tell me, is more information better? You tell me. That's from a Bloomberg terminal, and you know what? More information is not better. And I can tell you, my mentor, Dick Crum, who established our firm in 1976, he told me, Mark, don't try to be too smart and don't try to be too right because you're going to be wrong. It's the biggest mistake you can do. And also, I do really believe that there is a difference between information or knowledge and wisdom. Wisdom, in my opinion, is to take the 100 million gigabytes of information and focus on the 3 or 4 concepts that make the most sense. And that's what a good financial advisor will do is keep it simple, stupid, and we're not trying to be stupid, but it works. Okay? We're not trying to simplify what we do, but it is very effective. Okay, here's some interesting studies that have been done. The first one is a brokerage study by 2 guys at Cal Berkeley. And what they did is they went into a brokerage firm, and I don't recall which brokerage firm, and they analyzed 10,000 accounts for 7 years. And what they were paying attention to, they wanted to know, out of all the stocks that were sold, that were recommended and to be sold by the stockbroker, how did they perform versus whether they had kept them? And what they found is the ones that the broker sold did 3% better than the ones that they bought. Okay? Another one is another study by a guy named Andreessen. I don't recall which institution. He broke people, his study, into 2 different groups. Each of them were given a stock portfolio of 20 stocks. Test group number 1 was given no news whatsoever. All they could do is see their stocks, they were up or down each day. The second group was given the same stocks, but they could do as much research as they wanted. They could watch CNBC, they could watch Google, do whatever they wanted. And this probably won't surprise you, but the group with no information did twice as well as the group with the information.
So whoever wins the stock market contest, don't get too big ahead.
Yeah, especially with 4 stocks. Right. Okay, so expert opinions. This is also something that we do, is because finance and investing is so complicated with so many variables, we tend to latch on to one person or a couple people that have guided us well in the past. Think Jim Cramer. Say you made money from Jim Cramer. And so when you're watching CNBC, who here watches CNBC? Okay, it's pretty. I've listened to it on the car ride in because it's entertaining. But these are some smart people. I mean, these are highly educated people. They have conviction, and they're entertaining. And so what we do is we tend to put them in a box that they know all there is to know about finance. Even their tagline on CNBC is they're the resource for the best financial decisions. And it couldn't be further from the truth. So here's my next video debacle that you won't be able to hear. But you can watch it. Okay, ready?
Ready.
Bear Stearns is fine. Do not take your money out. This is real. If there's one takeaway other than plus 400 something, Bear Stearns is
2008.
in trouble.
Charlie, we talked about this yesterday. Lehman Brothers, he is no Bear Stearns.
I would concur with Charlie that you can't compare Bear management and Lehman management. Lehman management is incredibly engaged and responsive.
Will Merrill need to raise capital? No. That continues to be the refrain from management, from Mr. Thain. You saw they raised $12.8 billion in capital, remember. $4.2 billion of that was excess capital. No need to raise additional capital, says Merrill Lynch.
Bank of America is now the cheapest and the best, and I have to admit that as much as I like Wachovia, I think Bank of America is going to 60 in a heartbeat.
This morning in New York City, AIG basically gave some sort of insight into how much they may owe and how much they may lose. What they're saying right now is that the subprime losses or their exposure or whatever's going to happen to them is very manageable. Does it mean that they're not going bankrupt? Does it mean, obviously they're not, they're the biggest insurance company, they're well capitalized.
It's not rocket science, homeowners. It's apparently alchemy. You just had to tune into CNBC shows like Fast Money and Squawk Box. Reasoned financial reporting that combines the raw speed of fast money with the intelligence of a box of parrots. You just had to know how to listen.
You should be buying things and accept that they're overvalued, but accept that they're going to keep going higher. I know that sounds irresponsible, but that's how you make the money. That's why the market just won't quit, no matter how poorly actual companies are doing.
The worst of this subprime business is over.
Very simply, I believe that it means it's time to buy.
Fundamentals are coming back into place. I think people are starting to get their confidence back. Wow. If I'd only followed CNBC's advice, I'd have $1 million today. Provided I'd started with $100 million. How do they do it? How do they do it?
So, the point is, look at the conviction these people have. I mean, this is in the thralls of a great recession. And if you're following one of these people, let's just say it's Jim Cramer or any of the others, and you have a good history, you're going to believe what they're saying. And it only takes one wrong prediction to throw the train off its track. Okay, so here's some ways to kind of rules of thumb to better your chances. Again, keep in mind that we are hardwired to make mistakes and be very emotional. These are things that I like, commitment contracts. And they don't work entirely, but they work better than nothing. And one type of commitment contract is an investment policy statement, which is a written document that shows, here's what I'm going to do. And so say, for example, an investment policy statement would be, according to my goals and the income I need and the return I need, I am in 50% stocks and 50% bonds.
So one of the things that you should have in your investment policy statement is your asset allocation.
And then once you have your asset allocation, it should say, I'm going to have this percentage in U.S. value stocks, and this much in U.S. growth stocks, and this much in emerging markets, and this much in European stocks, and this much in bonds. So it's a blueprint of what your investment allocation should look like now, and also it should incorporate some other things like a rebalancing strategy. If my accounts go up 5 or 10%, I am supposed to, in writing, sell the ones that have gone up and put them into the ones that have gone down. So what am I doing with the rebalancing is I am now selling what's high and buying what's low. Okay?
It should probably also include what you will not do, options, limited partnerships.
Correct. So the idea is to pull this thing out when a tough decision is to be made, and hopefully you've signed it too, showing that you've agreed to it in the past, so that when this time is different, you have a little better tool to help you get through that. No, it's not different. It's the same, just different players, different circumstances. I think it's important to get a buddy. And what I mean by this is when the you-know-what is hitting the fan, whether it is in a bubble type market or a collapsing type market like the Great Recession, you're not going to want to do what that document says. I can guarantee you that. And I have specific examples of clients that we had conversations and documentation that what we were going to do. This particular person had a liquidity event that sold a business. that if the market was down 20%, I'm going to buy 20% in stocks because they were waiting. They thought Europe was going to explode and that we were heading to a major recession. So the market went down 20%, and I called and said, okay, it's time. And he said, I think it's going to go down farther. Okay? So I'm not ready to do it. And so his buddy was his wife and said, do it. Okay? And he did. They did it. And it worked. So a support system is sometimes better because we're hardwired. And then also, I think it's always a good idea to ask additional questions with anything in life. Entertain competing hypotheses. If your confirmation bias is that I'm really negative and I think the world and this debt is going to really affect us, you need to ask additional questions. One is, what if I'm wrong? Any decision I'm making, whether it's I'm going to put 100%, I'm going to buy a house for $2 million, put no money down with a variable arm that matures in 3 years. It would have been nice to ask the question, what if I'm wrong? What would happen after 3 years? What if rates go up? What if there's a collapse in real estate? And also, a good question that we ask in our investment committee meetings all the time is, what don't we know? And once you start asking these questions, you start getting some interesting conversations around that. So these are just a couple, additional things that I've found useful. By the way, on all this mind stuff, some recommended books. I think this is a really good book. I've read probably at least a half dozen, maybe 10 books on the subject. This guy tells a lot of stories, and you can get the concept of this behavioral economics. This is the book from who I call the founder of behavioral economics, Daniel Kahneman. And it's also a good book, but it gets a little unwieldy at times, a little researchy. But it is a New York Times bestseller. Okay, so takeaway number one, I've got
15 minutes.
Takeaway number one, okay, is know thyself. Know that we are hardwired to make mistakes. Okay, here's the takeaways. And I'm going to go through these fairly quickly. Takeaway number two, which I've mentioned a couple times, is find the right split. Okay, your asset allocation. How much do I have in cash? How much do I have in stocks? How much do I have in bonds? How much in real estate? How much in gold? So on and so forth. And the way you get to that answer is it's based on your goals. How much are you spending? How much money do you need to get your investments producing? So say we go through the whole analysis and you're spending $100,000, and which equates to a 5% return on your investment. So say you're retired. So to get a 5% return, you have to take some risk. And so say it calls for a 40% in stock allocation to get you there, but also you need enough liquidity to cover it so you're not selling things when the market is down. So as soon as you find the right split, research has told us that that's 93.6% of the game. Your return is 93.6% of that, and that's a very exact number, but of your return is based on your split, not what's under the hood, not this manager versus that manager, or how much you have in this type of stock or that type of stock. So once you get that question answered and you implement it, you're almost home free, or at least a good way through that. Understanding risk and return, I'm sure this was covered, but here's my take on it. You guys have seen this chart, I'm sure. You all know that bonds have lower risk or lower volatility than stocks, most types of bonds other than junk bonds. And so when you're building a portfolio, you have to go in knowing that stocks are going to be more volatile, but they're also going to have a higher expected return. So here's how I view risk versus return. One is you have to analyze your ability to take risk, your need to take risk, and your willingness to take risk. What I mean by that is ability to take risk. It depends. This is financial planning. This is what we go through with clients. Someone who is highly liquid, meaning they have a lot of assets in a bank account, can afford to take more risk, okay? Because they can tap into that money for living expenses or rainy day type fund. Someone who has very stable earned income. Say they're running their own company that's very predictable, or they have a job that they feel very strongly that they're not going to get laid off, okay? That person can maybe take more risk. if you have an investment horizon, the time between now and when you're actually going to need the money, you can theoretically take more risk. So if I had a, say a 5-year-old kid who's going to be going to school, college in 13 years, I could presumably have a higher allocation to stocks than someone who had a 16-year-old who was going to school in 2 years. Okay, so that's your ability to take risk. Here's some investment horizons. I don't know if they're exactly perfect, but if you have 0 to 3 years before that person is going to school, that student, you should be very little risk. I mean, I could make an argument that no more than, say, 10% stocks. Most of that money should be liquid.
For that particular piece of the bucket.
For that particular bucket, that's a good point because people have different buckets. If you're 20 years from retirement and you're 18 or 30 years old, you can afford to take more risk. Now, this doesn't go to the next subject, which is your willingness to take risk, but the longer the time horizon, the more aggressive you can be. But your need to take risk, what am I on here? Oh, your need to take risk is, to determine how much money, how risky you need to have the portfolio depends on, one, what are your goals? So someone, I made reference to the person who is spending $100,000, which means, and say they have $1.5 million, if they don't take risk, they run the risk of running out of money because the investment returns are not going to be keeping up with the withdrawals. People who are saving or spending, people who are, again, 30, 40 years old, can take more risk than, say, someone who is retired. Not always, but it's another consideration.
Do you remember?
I don't know exactly, but from the top of the market to the very bottom, the S&P 500 was down 50%.
50%.
Yeah. So the point is you have to know that that can happen. Takeaway number 3, and again, I realize these sound very simple, but it is simple. Now, designing a portfolio and how much you should have in each type of stock is a little more challenging, and I can give you resources to go find that out. But diversification is, so say we have our right mix, and it's 50% stocks and 50% bonds. Now you go into the stocks and diversify amongst the different stocks, okay? So you've probably seen this. Have you seen this? Okay. So things go in trends, okay? Now, I've highlighted the emerging markets because it's the most volatile here, okay? It's kind of hard to see in this thing, but this is what it does. This is the emerging markets. You take any investment, a bond, a treasury bond, a stock, anything, it goes up and it goes down, okay? So this is why you have not all your eggs in one basket. So it's down, emerging markets in 97 was down 11, and then down 25, up 66, down 30. It was down slightly, then up 56, so on and so forth. But things go like this, okay? And so in our portfolios, if we don't have one sector or one type of investment that is down in any given year, then we're not diversified. There's always something down, okay? And so a properly constructed portfolio has that kind of diversification. Volatility, this is more the recap stuff. Small company stocks, otherwise known as small cap, they have a much higher average return, 12% versus the large companies, 10%. They have a higher upside in one given year, but they also have a lot bigger downside, okay? So what people, do-it-yourself type people, you need to see how, you need to kind of run a Morningstar report or understand what type of stocks you have, because if you're not aligned and you have a very low risk tolerance, but you have 20% of your money in small caps or emerging markets, you're going to have a surprise when the market grinder comes to your door, okay?
And that's one of the reasons why you have to know what the objective of your mutual fund is if you own a mutual fund. If you don't know what the objective is, you don't know what kind of risk you are taking.
And it's not even that simple because managers will go, if you've ever seen a Morningstar box, you have large cap and small cap here. They'll go in between. So a lot of managers, they call it style drift. They'll go from large cap, large companies, to small cap. You have U.S. Large company mutual funds that are all of a sudden buying emerging markets or Europe. And you need to understand where they'll go. Okay, I got the 5-minute signal. This is a huge one. Takeaway number 4 is minimize fees. What this shows you is $1 million, assuming a 6.5% rate of return over 30 years, at a 1% management fee. So say you're paying your insurance agent, your broker, or someone like me 1%, that would grow to hypothetically $5 million. But if you paid that person 2% per year, it's 3.7. 3%, which is a lot of annuities and insurance products, 2.8. So fees do matter. They're real dollars, especially when you're compounding.
And that's the second thing that we talked about in mutual funds, that you have to know your expense ratio. Objective expense ratio, it really, really does matter.
And there's been studies, I didn't bring the graph, but on U.S. domestic stock managers, 75% of them don't even beat their index. And it's because of the fees. Okay? Takeaway number 5, I mentioned this early, rebalance. If you have a rebalancing strategy or your advisor, and these are the kind of questions you also need to be asking your advisors, because remember one thing, your advisor is a human being and has these 2 things here too. Okay? So you want an advisor that has a process and a strategy around all these things. Rebalancing, oops, sorry. So a rebalancing strategy could be if my stocks, I'm this 50% stock, 50% bond investor, if my stocks grow to 55%, I instantly sell 5% of the stocks, take it down to 50, and then rebalance it to the ones that are down. That's a rebalancing strategy. So what it does is it systematically gets you to buy low or sell high and then buy low, because we tend to do the opposite. And then takeaway number 6, finding the right advisor if you're not a do-it-yourself person. And I mentioned this, they have to be disciplined. And there's a series of questions. If you're interviewing someone and they tell you how they do it, drill down, ask an additional question. How do you specifically do that? What happens if this, what do you do if this happens? And you need to pay attention, because you should have an answer like that. And if they stall or kind of shift or whatever, then that's a cue that you need to ask even more questions, okay? Caring, I mean, your advisor has to actually be empathetic and care about your situation. There's, as Pete said earlier, there's money managers that only manage money, but if you have someone helping you with the other stuff, they're going to focus on all this stuff, keeping fees to a minimum, because it's in your best interest and you'll have more money at the end of the day. I wish I could tell you how exactly to do that, because a lot of people in our industry are salespeople, and they put on a good show. So again, ask additional questions and it'll help you. And then skilled, Pete mentioned this early on. Don't get caught into the alphabet soup of designations. If you interview someone and they give you their business card and they have like 8 designations on their card, you better drill down and see what specifically that designation is. And I advise you to even go to the websites and like you were going to try and get the designation yourself and see what's entailed. Because Pete is right. There's probably hundreds of designations out there, and a lot of them you can get with an 8-hour open book test, or some of them you can get just sending a check in. And it's very dangerous. So you want to look for a certified financial planner, which is a rigorous study and testing program. CFA, Chartered Financial Analyst. There's the SEMA. There's probably about 5, 6, 7 different designations that are really hard to get. And
well, I would focus on a couple of them, and that's the CFP for one, the Certified Financial Planner, and the CFA, the Chartered Financial Analyst.
Right.
A Chartered Financial Analyst, that was Jim and Christine. They're primarily out there picking different investments. The CFP is more of a global, looks at your budget, net worth, insurance, estate planning, etc.
correct. Yep. And Okay, so just in closing, gosh, I ran out of time a lot. Focus on what you can control instead of what you can't control. One thing you can't control is the markets. You can't control, you can't market time. You can't control our brains and how we process information. So build checklist systems around it to give you a better ability to get through these mistakes that we make. You can't control what the media is going to say. It's always going to be on. Okay? So if you're one that gets sucked into the media, turn it off. Or at least have a better understanding of what they're doing. Market timing. You can't control getting scared. All advisors were scared in 2008 and 2009 too. What starts going through our minds, as well as everybody else's mind, is this different? We start asking the same questions. But it's what you do once you're in that situation. If you stick to the system or the process that you've always maintained, you're going to be better off than going on the emotional roller coaster. So you can control if you know your tendencies, if you know you're conservative, or if you know you make rash decisions, ask additional questions. The right mix, get the right allocation of stocks, bonds, alternatives, diversify your portfolio, reduce expenses, rebalance, and I didn't talk about this, but minimize taxes. Taxes have a huge role in your portfolio and your net worth. So managing tax is very important.
Yeah. Most people do not look at their taxes at the end of the year. This is a great opportunity. We're coming in. This is actually the least busy any CPA is in the country because we're after October 15th. It's just a great idea to, call them up and say, hey, let's get together for an hour and let's see what we can do to minimize our taxes. If you're in the required minimum withdrawal, take a look at that. Take a look at the Roth IRA if you're still in that particular category. But taxes is really something that you can control. Take a look at it. You want to say a last word?
Thank you very much for attending. That's it. I got it.
Thanks, Mark. Yeah. Really appreciate it. That was an excellent presentation. What we're going to do next is that, John, come on up. Testing. Yes, it does work. John is not a certified financial planner. He's a chartered financial analyst. And what John does is that he is an owner of Knightbridge Asset Management, and he is another different animal in the zoo. And what he does as a business is picks out stocks. He's one of those managers that operates your personal portfolio almost like it's its own mutual fund based on your objectives and what you do. And so when he says diversify, John, what's your answer when you want to get over here to the mic? Sure. When you say someone says they should diversify, what would you say?
Well, when it comes to diversification with our clients, that means stocks and bonds. We stick to what we think we know, which is stocks and bonds. But it doesn't necessarily mean within a portfolio we need to own 100 stocks. We believe that perhaps owning 20 stocks would be sufficiently diversified, which can be controversial.
Yes, very. Yeah. How large is your firm?
We manage $600 million in assets.
600 million assets. How do you charge your fees?
You can see it on the Ask First form. We charge what's known as an asset-based fee, a management fee, which is a percentage of the portfolio value.
And what is that percentage?
It depends upon the size of the relationship. We give clients a break as their assets increase in size, as much as 1.6%, as little as 1.2%.
And that's on an annual basis?
On an annual basis.
Okay, but you don't invest in mutual funds. You actually pick the companies yourself.
Right. So we are a research firm. We build individual portfolios. We're a money manager.
Yes. Questions of anyone as far as his business is concerned?
That's a good question, and I'll
repeat the question.
That's a good question. I'll move quickly since we have limited time. So the question is, are there any other fees? Are there transaction fees? And if you work with a money manager, our job is to do the investing. Someone else is going to hold your money. It's nice to have that separation. A bank custodian, a brokerage firm, folks like Charles Schwab, Fidelity, they are the custodians. So they will charge as well. It's a relatively limited amount, a few $100s a year, typically $5 to $10 per transaction, and that would go to the custodian. So commissions to the custodian or the broker, that should be, in this day and age, a small amount.
Should somebody asking you what your performance is?
So you can go to our website. We're registered with the SEC. It's important that a money manager calculates performance according to the CFA GIPS standards, which we do. And so we do have a track record that goes back to 1992, which is ahead of a benchmark. You need to compare your results to a benchmark. So in our case, the S&P 500.
In fact, one of the things that we're going to do for the contest today is talk a little bit about benchmarks. So why don't we get right into it?
Sure. Should I write down the benchmarks?
Sure.
So the stock contest was from September 14th. Those of you that participated September 14th.
You want to get over there to the, and you tell me what to write.
So as some of you may have noticed, the stock market hasn't done so well the last month or two. So since September 14th, which is when we began the contest, through October 25th, I'd like to first go through some benchmarks performance. So
why is benchmarks important?
Well, there are times in which your investment results will perhaps be negative, but the question is, how did those results that might be a loss compare to a benchmark? We try to make money in any environment, all markets, but in a year like 2008, that was very difficult. So the question then is, well, how do you compare it to a benchmark? The important thing is the benchmark needs to be relevant. It needs to be applicable, the right benchmark. If you have a portfolio of stocks, clearly you need a benchmark that is made up of stocks as opposed to bonds. One example of an equity, a stock benchmark, would be the Dow Jones Industrial Average. That's fairly well known. However, it's only 30 companies. The Dow Jones Industrial Average during this stock market period produced a negative rate of return, negative 3.7%.
3.7?
Right. Now, the benchmark that we tend to use, I think, is more representative of what investors look to accomplish when investing, and that's the S&P 500. So it's 500 companies, and that return was negative 3.5%. Negative 3.5. Now, there are two other benchmarks I'll mention that focus on subsets of the 500, and that's the S&P 600, the 600 smallest companies that Standard & Poor's tracks, S&P 600. So if you hear about the S&P 600, that's small cap, and that was negative 6%, which is sort of what you'd expect in a lot of negative return environments. The smaller companies are down more, as we just heard. One other benchmark, the S&P 400, which is a mid-cap, mid-sized company benchmark, was negative 4.8%.
Boy, it seems like it falls right in line
Exactly.
with the, what is it again?
Negative 4.8.
4.8.
Now, I'm including one other since some people had foreign companies, international investments in their stock contest. The EAFE, E-A-F-E. E-A-F-E. Europe, Australia, the Far East, an international benchmark was negative 2.6%. So when we talk about diversification, that can include companies outside the United States, and in this case, it would have been helpful to have that exposure. You were down less, which is the idea behind global investing.
And any questions on benchmarks?
What about the Russell 2000?
I don't have it, but it would be very similar to the S&P 600. They're both made up of small companies, but I don't have it.
Russell 2000 is a small cap. Russell 3000 is more the small cap and the mid cap, so that would be around the S&P 400 range. Okay? But performance is important. Most clients know their own performance before they come into you?
Usually not.
Yeah.
And I think, there's two quick questions you want to ask any advisor. What is my net of fees performance? And how does that compare to the right benchmark?
Yeah. Those are two major questions. By the way, do you manage your own money the same way you do your clients?
That'd be the next question. What do you do with your own money? And we do. We invest. My portfolio looks like a client's portfolio.
Is that because of the discipline, so it doesn't think that you can outsmart the market, or?
You know, some people think that there's some conflict of interest. You turn on CNBC and the person being interviewed claims they have no exposure to that which they're talking about. We look at it the other way around. We want to eat our own cooking. If it's good enough for a client, it should be good enough for us.
Yeah, I agree with that. You want to do the contest?
Sure. I can highlight some of the stocks. Do you want me to start with the winner? Work backward, or-
How about a little highlights overview?
Okay. So we know that the overall stock market declined during the September-October period, but nonetheless, as always, there were some companies that managed to appreciate, and I'll just go through some of the successes, some of the stocks that did well. What is most interesting to me is one portfolio did extremely well, and it's made up of something that might surprise you, that it's actually going up a lot more than the stock market, and those are home builders. So some of the best results came from stocks that are connected to the housing recovery we're starting to see. So, for example, there are 4 here: Standard Pacific, M&I Homes, KB Home, Pulte Group. They were all up, and they were all in this one portfolio. KB Home was up, I think, the most of any stock in the contest, up over 20%. Home Depot, connected also to housing, was also up 1.7%. Most stocks were down, so to just be up was a good thing. Someone was very smart and included, I'm not even sure if this is legal, included an ETF that's a bearish bet. So it's levered 3 times to the downside. And so it went up because the market was down. So that was a portfolio hedge that was up 16%.
That was illegal.
Yeah, I thought so. Yeah, so we'll see if you're disqualified. Some other successful stocks during the period included Pfizer, a more defensive investment, being drugs.
Doggone it, Viagra went up again, huh?
Yeah, exactly. Very dependable. So Pfizer was up 7.6%. Kraft Foods, also foods, packaged goods, more defensive, up 1.8%. Verizon, another dependable company. The nice dividend was up slightly, 0.5%. General Dynamics, that's interesting. They're in the defense business. A lot of uncertainty. Nonetheless, the stock was up 2%. Procter & Gamble, another great company, viewed as a solid company, was up 2.1%. So most every stock that was up is viewed as a high-quality, blue-chip type investment, and those tend to perform better in down markets.
Give me a 2-minute prognosis of what you think is going to happen in the market in the next 6 months. In 2 minutes or less, of course.
6 months?
And it has to be right.
I'd be surprised if anyone here is out there actively investing, as opposed to, I suspect you're all waiting. Waiting for what? The election, the fiscal cliff, maybe some resolution around Europe. What we see is everybody's on hold. Everybody's waiting. When is the best time to invest? When everyone else is cautious. There's more short positions. The bets that stocks will decline are the highest they've been in, I don't know, 8 years, something like that. So people are very bearish. They're very cautious. Companies and investors are sitting on more cash than pretty much ever before. And you know what the return on that cash is? 0. So it may take some time. Maybe we have to get into next year, but I think it's probably a reasonably good time to be investing in the stock market. I fear that, I don't know if 6 months, but 6 years maybe, I fear bond investors are taking a lot more risks than they realize. Whenever interest rates increase, which they eventually will, bond investors, particularly in mutual funds, can lose a lot of money. So I think it's actually a time to sort of flip things around and be more cautious. We are being more cautious in the bond market with some shorter term maturities, and we are finding great opportunity in stocks. Maybe you average in, put some money to work over time, but when you can buy stocks that have dividend yields at 3%, 4%, 5%, which is higher than the bond yields you might see, that sounds good.
Yeah. Okay, let's go to the winner. And because they're going to be able to receive a signed The Next Decade by George Friedman, signed copy. We're going to have a Foundation Office coffee mug and a mouse pad, and of course, the famous plastic clip with a magnet. Woo! Woo! So who's that first winner?
I would read that book. That's a good book. The winner with a portfolio gain of 9.7%. They did own these home builders I mentioned. Loretta Umetsu. Is Loretta here? Congratulations.
Here you go,
Great
Loretta.
win. I'd like to talk to you afterward, please.
It has to be a woman, see? Women are better money managers than men.
Very true.
Who's second?
And second, with a gain of 0.1%, and that's amazing. Only one investor made money during this period. That's how difficult it was. So don't feel bad in your own personal lives if you didn't make money. Don James. Don Jones, sorry. Don Jones.
Hey.
Don.
There you go. Congratulations.
I mentioned Pfizer and Kraft. Those were in his portfolio.
Okay, who's next?
Okay, third place, John Breen. Is John here?
Congratulations.
Congratulations.
We ran out of those magnetic clips, but I'm sure that...
John, he was negative 0.8%, slightly less than 1%. Made money in Merck. That was a good stock for him.
Who's next?
Fourth place is interesting because they had four stocks that were just about flat. So sometimes winning is not losing. In this case, John Lim had Bank of America and AIG. And those are two stocks we own in our portfolio.
He
So
probably listened to Jim Cramer.
I think highly of you.
He's not here?
John's not here.
Okay, who's next?
He was down 1.7%.
Who's next?
Fifth place is Gene Suk, if I pronounce that correctly, Gene.
Oh, congratulations, Gene. Could you get that?
Negative 2.3%.
Start naming.
Sixth place, Carrie Calderon. Carrie? Carrie's
Next.
not here. Okay. Seventh place, Allison McMillan Lee.
God, they're missing this glass cup.
How about Marilyn Greenwald? Yay!
Yay!
Pick
You could-
Pfizer.
You could toast him and then have a little keychain.
Good pick with Pfizer there. Umberto Quezada.
Here you go.
Had Procter & Gamble. It's a good stock.
Yeah, you're welcome. Who's next?
One more.
We got some more.
Chet Lakhani.
All right. Our lone Democrat.
How about Cy Winter Tamaki? Cy.
Who else?
He had
Cy.
the bearish bet. So
Wow,
we're going
Cy.
to give him.
We're going to give you the youngest individual to ever take the workshop course and one of the winners. There you go.
Another one?
Yeah.
Siva Hari.
There you go. And that's it.
All right.
Thank you, John. John is, really appreciate it.
Sure. I passed out our quarterly letter if anyone's interested in reading up on the market and the investment environment as we see it. That was published just a couple of weeks ago, so it is, I think, interesting perspective. We talk about inflation, so feel free, and if you're interested, we can send you future copies.
Yeah, just give him your name and address and he'll put you on the mailing list. You'll not get a phone call the next day. It's a good newsletter. It's always interesting reading. Janice, come on up. Janice actually has put this whole program together, so yeah.
Thank you so much for coming. We're delighted to have you. We hope you will consider the next series, which is in April and May, Mondays. It's the It's Your Estate segment, and with Peter and his lineup of guest speakers. And I also wanted to mention one of the other programs that the Library Foundation does is the annual Witty Lecture Series. We're in our 16th season, starting in February. And one of the speakers is Barry Ritholtz, who will be talking about This is Your Brain on Stocks.
That ought to be interesting.
He'll be coming May 10th and 11th. And it's information in our newsletter, which is in the back of the room. And we'll be glad to sell tickets to you, or I can give you more information. Thank you so much.
Last but not least, please take a look at the evaluations. On the top, it asks you, how would you describe yourself as an investor? This gives us an indication as to who does the program appeal to? We appeal to the very beginner, we hope, and then we appeal hopefully to the sophisticated individual that they get something out of it. So it's a major stretch. The moderator, just put number 5 on there, ignore the rest. Annuities, mutual funds. So remember that session where we talked about annuities and mutual funds as to what to look for? We mentioned objective, expense ratio, and if you're going to pick out a manager, know their track record. If you don't know the track record, go to an index fund. Financial planning, Carl Lackman from Eclectic, he did 2 sessions. Long-term care, Carol Ann Burr. Fixed income, Jim Fletcher. Equity, Christine Blanchard with Powers Capital. And I would love to hear how you feel about today's session called The Big Takeaway. It's brand new. So please put a comment in there if you can. If you would like to recommend the workshop series, please let us know. We're totally sponsored by charitable organizations. We basically give these evaluation compilations and say, this is how much the group loves it. Please sponsor us again in the near future. One of the most difficult things to do is to figure out where to put advertising on how to inform you as to when the next workshop is. So if you would like, please let us know how you found out about it. Any kind of comments you want to put on here as to the workshop series, please let us know. The back of it goes kind of to the mission of the workshop. Well, our mission is to put you in control of your own money. Okay? It's not your children's money, it's not your advisor's money, it's your money. Hopefully you feel somewhat more in control. That's the goal. The workshop series was educational. We like to be the antidote to the free lunch seminar. If you understand the difference between a salesperson and a financial advisor, we have accomplished a whole heck of a lot. I'm more confident and relaxed about my own financial situation. So if you can kind of say that check to the mortician will bounce, that's the perfect financial plan, right? Because you can only spend it here on earth. Have you included any charity in your estate plan? Again, we're sponsored by charitable organizations. If you have and have listed any one of them here, please circle them. It makes them want to sponsor us again. We didn't talk much about this, but there is such a thing as a charitable gift annuity, and it's a part income, part gift scenario. And if you're interested in a $10,000 or a $25,000 gift illustration, please put your email address in there. We will only send you out the gift illustration, nothing more. If you want more information, let me know. I'm the only one that will receive it. You will not get a sales call afterwards. If we had additional classes, what would it be? And if you want to be on our list just for the workshop series, please give me your email address and I'll make sure that you get our email coming up in March for the April program. Last but not least, the only thing that I think is, well, the only thing I think is really valuable is your time, right? Because it's limited and you chose it to spend it here. So my thank you to you all for doing that. It's wonderful. See you next week.